What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Yeah, real quick, what's your podcast on with adoption?
It's called Hey, Am I Adopted?
Okay, are you adopted?
Well, that's the issue. My whole family is. My wife, myself, and both of my daughters.
Oh, really?
And so we have a podcast, and we just interview adoptees. No foster parents, no anything like that. So
Gotcha.
we're trying to, we've been on it for about 2 years, going to middle of our second year, and pretty interesting. The three of us were adopted through the Catholic Social Services when we were infants, and my wife was adopted when she was like 2 through a marriage. So we all have different stories and different feelings. But are you adopted?
I am adopted. I would love to come
God.
on that podcast. Yes, I'm adopted actually through Catholic Charities as well. So really interesting.
Well, you need to come on our podcast.
For sure, man. Send me the link.
I will. I'll
to
send
get
you. But it's
scheduled.
called Hey, Am I Adopted? Okay, we're taking a hiatus right now, probably until November, but we'll be back up then, and that would be great. Huh. How old were you when you were adopted?
I was about 3 months old.
Okay, same thing.
Yep.
Same thing with the 2 girls and myself.
Yeah.
So.
And I'm originally, well, I was born in South Korea, but I ended up getting adopted and went to West Virginia. So when I tell people that I'm from West Virginia, people are like, how the hell did you get there?
Yeah, that's for sure, right?
Yeah.
Well, one of my daughters and I were adopted through the Catholic Social Services in St. Paul, Minnesota. And then we moved out here, and our second daughter was, out here in Southern California. The Catholic Social Service office was in Torrance, California, and she was adopted there.
Gotcha.
Yeah, we had one of our girls, just a short story, one of our girls never could deal with it. She could never deal with the abandonment and the rejection issue, and at 14 she got into drugs, and at 34 she was dead.
Oh, I'm sorry to hear that.
Yeah, it was a constant battle for a number of years, and it was all the rejection and all the adoption stuff. But our best story on the deal is we had a guy who came on and said that he was in his mid-30s and he was heavy, and he was in the doctor's office, and the doctor said, "You've got some medical problem. Give us the history of your parents." And he said, "I'm adopted. I don't have any history." So they said, "Well, you need to go find your father, because this is where it's coming from. It's coming from your biological father." So he did, and 3 years later he found that his father was a Catholic priest.
Oh, wow.
And his father had an affair with a parishioner.
Yeah.
And over the years they birthed 2 babies, and both of them were given up for adoption without him, the priest telling anyone he was the father. And this guy found the priest and eventually found his real brother.
Huh.
So we had him on twice. It was kind of interesting. He wrote a book and then his story. So that's probably our most scandalous story.
That's pretty wild. That's pretty wild.
I guess so.
Well, cool, man. Well, yeah, I'd love to come on that show whenever you get recording again.
Okay, good.
All right, man. Well, so I think for my podcast, it's probably more up your alley as far as like what you normally talk about, raising capital, real estate, things like that. Really talking to active investors, entrepreneurs, real estate investors, as opposed to passive investors. So these are all active folks that are raising capital. So you're pretty used to being in front of those types of people that are again, raising capital, buying assets, things like that. So yeah, man, we'll keep it on the shorter side. I know we're running a little bit behind. Do you have a hard stop at 11?
11 is 3. No. What
Okay.
did I say? No, I don't. No, I don't. I thought we were I had mentioned to you that I thought we would talk about what am I looking forward to in the end of this year and next year in the industry.
Sure, I can certainly ask you that for sure.
Because I've got 3 or 4 things to talk about that I think are important to us.
Okay. Cool. Yeah, I will definitely bring that one around. Yeah, and then so we do like a main episode. It should be pretty on the shorter side. We don't go too long. We go like 25, 30 minutes, something like that. And then I'll kind of cut that off, and then we'll just go into a couple smaller segments that I go into, $1 Million Mondays, and then Top 1%, which are just really short little skits that we put into shorter episodes. All right, man. You ready to go?
Ready to go.
All right. Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. Gene Trowbridge is a legendary securities attorney that has been in the commercial and investment real estate business since 1972 and in the legal profession since 1996. He's a former syndicator of raising capital for over 10 years, and because of this experience, Gene can communicate with his clients both from a technical and practical point of view. He's the founding partner of Trowbridge NIE and a sought-after speaker and author. Gene, awesome to have you on the show. Really appreciate you coming on today.
Well, I appreciate it, Seth. It's great to get to know you. I got to apologize for my background, anyone watching this on video. Our house is on the market. We're trying to move, and we're clearing out, and basically today I'm at home organizing stuff. Not in my studio. I have a studio like you have, but so if you forgive me, we'll just go ahead.
All good, man. It's all about the substance, not the background, man. And actually, what you can see here used to be my garage. So we just built this out last month because I got kicked out of my office and my studio because we've got an incoming daughter. So I'm getting kicked out to the garage. So we had to renovate this space, and now it looks like a podcast studio. So all good.
For you.
Thanks, brother. Appreciate it. All right, man. Well, look, when a stranger comes up to you on the street or you're at a conference and they ask you what you do, what do you say, Gene?
Well, first of all, I tell them I'm a lawyer and I work with people who are trying to raise money from groups of investors to buy something.
Simple enough. Raising capital, right? They're getting groups of people together, raising capital so that they can buy not just real estate, but really anything, right? They can raise capital to buy a business. They can raise capital for into a fund to buy a series of businesses. Lots of different things, right?
That's right. In the last couple of years, we've raised money for people who bought a barn, if you would, of racehorses down in Del Mar. We bought partial ownership in a hockey team, an NHL hockey team. We've done fiber optics, and then of course quite a bit of real estate. Right now we're working on a lady who's building a French Vietnamese restaurant in Old Town Scottsdale, which is kind of an exciting project. So, Seth, when you want to do something and you use all your money, and then you use all your parents' money, and then you get all the money you can from the bank, and you're still short, you got to go to the public and raise money from investors to finish the rest of the equity raise.
That's right. And some people, and I guess I shouldn't be surprised by this, but I'm sure you come across it as well, they don't realize that there are lots of rules, lots of regulations around that. You can't just go out and raise capital and not pay attention to what you're doing. There's lots of things you've got to pay attention to.
That's exactly right. I wrote a book way back 1995. I wrote the first edition of my book, which was designed to educate real estate people, just real estate people, that hey, when you decide you're going to buy an apartment building with 5 or 6 investors, that's really not a real estate deal. That's a securities deal, and hey, you better know about it, or you're going to you're going to get in trouble. And so that was really my background, because as you said, I'd been a syndicator all up until that time, about 20 years, and built a lot of self-storage facilities in the Southern California area. Then for one reason or another, I thought I would do something different. So that's when I went to law school. I went to law school when I was 45, passed the California bar, and then I've been doing this for the last 30 years. Same business, different view, working with the same people and the same problems that I ran into as a syndicator.
For sure. And there's no excuse nowadays. I mean, information is everywhere, right? You can get on YouTube, you can search on Google or ChatGPT, or you can get into a mastermind or buy into a coaching program. The information nowadays is really out there, but I will say that it is somewhat counterintuitive for someone to be like, hey, look, I want to go buy this building, or I want to go buy this house and do a fix and flip, and I need some more capital, like you were saying. I've got as much as I can as far on the debt side. I've got, I've used up all of my cash, and now I'm like, okay, I've got to use somebody else's money. But I found, these 3 or 4 people that want to pitch in, and we're going to partner and things like that, and they're going to put in all the money, and I'm going to just do all the work. And it's a little bit counterintuitive that actually there's a lot more rules and regulations around that than just saying, here, I'll take your money and I'm going to give you a return on it. There's certain rules and regulations we have to abide by and we have to pay attention to in the security side.
True. They all think if they raise in money, you've heard this, well, it's just friends and family. Mm-hmm. I'm just with friends and family together. I don't need any of that other stuff. Okay. Or it's going to be less than 10 people. I hear that a lot. The old what do they call it? The old wives' tales that are on the street. You hear all that. But so there's a lot of education that goes on, and I do a lot of. You've seen my YouTube. I do a lot of education-based marketing, telling people what the issue is, and hopefully, if they want to keep out of trouble and stay out of jail, they're going to call someone like you or someone like me and get it done right. Right?
That's right. Gene, are you trying to tell me that there's no family and friends exemption?
Well, there is a family and friends exemption if you raise your money under a particular rule. You don't have to verify that everyone's accredited. You can take a certain number of those people and take their money and manage their money when they expect a profit, and all of a sudden, welcome to the securities world. So you have to take care of, let's put it this way, the government is interested in those family and friends being treated right and being protected.
That's right. So look, I'm a real estate investor. I'm looking to buy a property, for instance, and I want to take on some capital from a partner, we'll just call it a person. Like, at what point do I need to start paying attention to these securities laws?
Well, I think you need to start paying attention right away when you start saying to yourself, I'm going to take someone else's money. Because you know that the 4 steps to knowing it's a security is you take their money, you put it in a common enterprise, they expect a profit, but you're raising all the money and you're managing it. Even if it's just one investor and you're managing their money, the government has a vested interest in protecting that investor, so they wrote all these goddamn rules, and you have to follow the rules.
Oh man, all the rules, man, all the rules. When does it go from let's say a joint venture? So you do see people where they get together and there'll be, somebody that provides all the money, somebody that provides all the services, and they call it a joint venture. So what's the difference? What's the difference between a joint venture and a security?
I can't tell you. How many times have you heard people, it's just a joint venture, they're putting up 50% and I'm putting up 50%, and we're just going to do it together. And then you say, well, who's making the decisions? The guy says, well, I am. I'm making all the decisions. There you go. There's that 4th prong right there through the efforts of the sponsor. So it doesn't make any difference. As long as you're in charge of making the decision and your investor's money is under your control, we better be careful about what we're doing. And actually, I asked them, well, it's a joint venture. What entity are you forming? Okay. And they said, well, we're going to form a general partnership. Okay. Well, that could lead you into security just there. We're joint venture, but it's going to be a limited partnership. They're going to be the limited partner, and I'm going to be the general partner. Okay, I got you there as a security. Oh, we're going to be an LLC. They're going to be a member, and I'm going to be the managing member, but I'm making all the decisions. Okay, I don't know what you've got there, but you got a security.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. 100%. I like to say that the joint venture chooses you. You don't choose the joint venture. Yeah, you got to be really careful. Just because you call it a joint venture doesn't make it a joint venture. Now, if that's your goal, you can certainly work with your securities attorney to try to structure it properly so that it is a joint venture. But just know that you may have to give up, or you do have to give up some control. That's kind of the whole point. And there are other stipulations that go along with that. But if you want it so you maintain all the control and they're just providing money and they're probably expecting a return on that money, you're venturing into securities, and you can't just call it a joint venture and magically it's a joint venture.
No, and there's another one that happens I run into is the people say, well, this is going to be member managed. We're going to form an LLC. There isn't going to be a manager. There's going to be 6 of us, and 5 of them are going to put up 10%, and I'm going to put up 50%, and all the decisions are going to be based on our voting rights. Well, that means you're voting, and you're making all the decisions, and that's not going to work. That's not going to get you out of trouble.
Right. They have to have material or meaningful voting rights. It can't be just this phantom, okay, it's member managed, but one of the members in particular has all the voting and control rights.
Well, you know what I think, excuse me for the phone ringing, I think that, and I tell people, if you're going to do that, what you're going to do is you're going to give everyone a vote. You might have, in my example, 6 people. Well, then you have 6 votes. Anything has to be done unanimously. You can't have the 50% person make all the decisions, because then you've got yourself a security. So anyhow, those are all the things that we get paid big bucks to tell people how to do it right, so they stay out of court. Anyhow, whether they stay out of jail or not is really when they do really weird things, but at least let's keep them out of court.
For sure. What is it in your past that made you switch? So you were a syndicator, you were raising capital, you were buying assets, and then you decided to go to law school. Pretty far down the line there. What changed in your mind that you were like, you know what, I'm gonna pivot here?
Well, the 2 things I learned is that it's a people business. Being a syndicator is a people business. The last year I had a full-blown operation. I sent out 1,687 K1s. And in those days, there were no portfolios. There were no platforms. We did it all ourselves. A lot of licking stamps and envelopes and everything. And so I say that for me, the care and maintenance of investors just got to be overwhelming. If I was going to continue to grow, I was going to have to get more space. I was going to have to hire more people, and I decided that I didn't want to. The next thing that occurred to me is that there's always more risk than you think. And you know, in the last couple of years, I mean, when we were writing documents for investors in 2017, 2018, did we put in our risk section that here comes a pandemic? And those people who are going to buy apartment buildings, we're not going to be able to inspect their units, probably not collect rents from people because the government says you don't have to pay your rent. We didn't know about that. And then the ones we were doing in 2021 and 2022, did we know the interest rates were going to go from 3 to 7 in about 6 weeks? We didn't know that. So there's always more risk than you thought, and I'd had a good career. done a lot of it, and I just thought I wanted. It wasn't a midlife crisis, but I went home to my wife one day, and I just sat at the kitchen table where all of our decisions had been made, and I said, I've really had enough of this. I was using the broker-dealer community to raise money, and it was kind of a mess. And I thought, gosh, I think I've got some money coming in for the next 5 or 6 years. I think I'll go to law school and build my practice. And she was working at Target, and my kids were in grade school, and I'm going to law school, full time. It was kind of a mess, but it worked.
How did she take that conversation?
Fine. She thought it was great.
That's good.
If she was here, I'd say she'd probably said, well, it's not going to interfere with my life. You do what you're going to do. I got the kids, I got the house, I got my job. We'll see you. And I thought I could study at home, Seth. I had my own office in the house. It was lovely. But unfortunately, and you're probably too young to know this, that's where the Nintendo machine was. And so my 2 girls had to come in and play Nintendo all the time, and I couldn't study at home. I was kicked out of my office, so I did have to go to the law library and study, which I hadn't counted on. But anyhow.
Oh, I know Nintendo, man. I'm actually older than I look. I just turned 42, so
okay.
I know Nintendo. I know Nintendo, man.
Well, you're the same age as my girls, so yeah, that's the truth. I got kicked right out of there.
Yeah. What are you seeing out there? You mentioned a bunch of different, really interesting projects that people are raising capital for. Are you seeing more and more people raise capital for things like that, rather than, let's say, maybe a few years ago when it was all what seemed like it was all value-add multifamily? I know there was all kinds of stuff out there, but that was kind of like everybody's primary thing, and it was really going well. Are you seeing more and more people shift to different asset classes and different types of projects?
Well, my feeling is the reason I'm getting different things is my marketing has changed a little bit. I came out with a series of success story videos, and all of them were none of them were on real estate. I had just done 5 or 6 things that were different, and so I put that out in the marketplace, and people caught on that Gene does more than just real estate, and so that kind of builds my business. But I know very successful attorneys who probably do much more work than I do, who just do real estate, and that's fine.
Yeah. Any kind of insight into what's working with your clients as far as raising capital? I know it's been difficult out there. I'm chief legal officer for TribeVest, so we see lots of fund of funds come through our door. So we see a pretty broad picture of the market, and across the board, it's really difficult to raise capital right now, especially if you just compare it to, let's say, a few years ago when it was just fairly easy to raise capital. A lot more difficult now. Investors are a little bit more skittish, a little bit more aware of the economy and things that are going on around us. What are you seeing out there that's actually working for your clients?
Well, one of the questions I ask a new client that's coming into me is right away, I want to know, and I always use this term because they laugh about it. How big is your Rolodex of investors? Okay, no one has a Rolodex anymore. It kind of dates me. How big is this? Do you have a bunch of? I've got a guy right now who's only going to raise $1.5 million to buy 4 little mobile home parks in Ohio. Well, I said, how many people do you have that you think you're going to call on to raise money from? He said 3. I said, yeah, okay, that's not going to do it. I don't think you're really thinking. I don't think you're thinking that through. But I think that's real important. You've got to always build your database, right? Everyone, that's the one thing you do constantly in this business as a sponsor is meet people and build your database. And I have a deal that one of my YouTubes is called Sell the Sizzle, and what I learned when I was a syndicator myself, it doesn't do any good to walk up to someone you don't know with your PPM and say, boy, have I got an investment for you. And in my world, it was a mini storage facility, and they only buy Bitcoin. I wish I'd known that before I I said this to him. So I think you have to find people for your database that, number one, are interested in real estate, period. Number two, are they interested in the type of real estate you're going to do? Because I believe real estate is a specialization business. I mean, if you're moving from apartment buildings to RV parks, what do you know about RV parks? You know, what do your investors know about RV parks? I think that's risky. So you got to find what type of real estate do they want to invest in that you're an expert in, okay? And then do you have a team to tell them about, well, my team is going to work with me so we can uncover the opportunities in the piece of real estate in my specialty that we're going to invest in. And so if people in your database, they want real estate, they want your type of real estate, they've already bought into your team, now you show them the PPM and the deal's practically done. Now we're just into, do they like the color of the building and the neighborhood, you know. So, and I think it was like when I started, I was just, boy, give me the PPM and I'll go talk to people. And it's just a lot easier if you build the funnel from the top all the way down to the people that say, here's the deal. So I try to teach my people that.
Love that, man. Yeah, I think people think that just because whether they're raising capital with someone else or they're raising capital themselves for their own specific lead sponsor deal, they think if they have a great deal, the investors are just going to flock to them and they're going to get fully funded and it's going to be easy to raise capital. But that's not the case. There's a lot of things that go into that. Like you said, you talked about your funnel, you talked about networking, educating your investors. They're going to be investing in. You've got to know what you're getting yourself into. You've got to know your business inside and out. You've got to have a network, and you can't just say, "Oh, I've got a great deal," and just expect it to get fully funded easily.
You're right, Seth. The thing that bothers me is I go places and I speak places and people get my business card and they put them in their database. So I get all the pitches of all their deals, or I'm on Facebook or I'm Instagram, and what's the number one picture? 34% IRR. Okay. You know, that's what they're going to lead with. And first of all, if you have any experience, you kind of think that probably isn't a very good number. Yeah. If you put 10% IRR in there, I might very well look at it. So people don't know. They're just hammering you with this yield. And that's all they have to talk about is the yield. And I think there's more to it than that.
Yeah, seeing a 10% IRR might be the sexiest thing, right? You're like, oh man, maybe that must be pretty low risk. So that's how you should look at it. Oh man, yeah, I love that, man. And and again, raising capital is hard. What we've seen really across the board, because there are all these masterminds and coaching programs and things out there that say that raising capital is easy because it has to. That's what the message that they have to say in order to get people to buy into their program. But the truth is, raising capital is difficult. And the people that we're seeing that have success out of the gate, not only do you have to know your business, know your deal, know your investment, but the most important thing is having that network built in, that Rolodex that you spoke about, right? Like if you're brand new to this business and you have that Rolodex, you have that network, you still might be pretty successful in raising capital because you have that network. That's the most important thing. And we're seeing that with lots of doctors and dentists and folks like that already have a network of high net worth individuals that know, like, and trust them. And they're having a lot of success right out of the gate compared to what we like to call mastermind scholars that are really just put together this, email campaign to strangers, or they started a brand new podcast or whatever it is, and they expect to say, oh, as soon as I get a deal, I'm going to put it out there and it's going to get fully funded. But those people are strangers, and they're really difficult to get over that initial hump to say, hey, send me a $50,000 or $100,000 or $250,000 check.
Especially send me a check, you don't know me, and I don't have a track record. Okay, yeah,
Exactly.
of course. And you know, you and I have probably been speakers at. I've been around a little longer than you have, but I can tell you all the mastermind groups and all the places that have invited me to be on the podium and talk. And so I sit there for 2 days and I listen to their program, and I just wonder, because I can harken back to what worked for me. And interestingly enough, you see it too, Seth, that someone comes up to you and says, boy, I've got this good deal. I can fund it with one investor. And I said, that's dumb, because you take all that money from one investor and then you go to a second deal, they're tapped out, and you don't have anyone to talk to. You know, cut it down. Instead of taking $1 million from one person, why don't you get 20 people at 50,000 each? So the next time you got 20 people to talk to, and they'll introduce their friends, and all of a sudden you got 40 people, and you've got to build. That's the number two thing in my training, which isn't a mastermind. I think the number one thing you have to do is continuity. Seth, if I'm going to give you $50,000, what happens if something happens to you? And if you can't answer that question, I'm not investing with you. So that's the number one thing you have to have, is a plan for continuity in your entity. And then number two, build your database.
Yeah, 100%. I do want to say that I don't have any negative feelings towards like coaching and masterminds. I think that that's the highest level of education nowadays. Like, you don't necessarily, I went to college for 11 years, but I don't recommend that for anyone that's not going into something like you and I, Gene, where we need a law degree, or, you know, we want to be a doctor or engineer or something like that. But folks that are buying real estate, or they're going to be an entrepreneur, they don't necessarily need that education, that formal education. And because you can get a coach, you can get a mentor, you can join a mastermind, surround yourself with the right people, and pay to be in those circles if you need to. All good there. But what I did want to say is just that, you know, be careful with who you get into those masterminds with, who you get that coaching from. Make sure that they know what they're talking about. Make sure that they made their money from the thing that they're teaching you what to do, things like that. And there's no better way to accelerate your growth process.
Excellent.
Yeah. Gene, I want to jump into this year, man. There's a lot of different changes in 2025 and even going into 2026. What are you looking forward to this year in our industry?
Good. I'm glad you asked. The very first thing I think that's happening, it's happening right now, is the rules on integration. We've always had an issue of when you're doing a 506B and a 506C, can you do two at the same time? When can you do? Is it 30 days and all that? And the real issue on integration is it's opening up. First of all, you can do a 506B and a 506C at the same time, as long as you follow the rules of each one. I would suggest looking at the old integration rules to say that it doesn't look like these are two offerings in the same piece of property. You're not buying the dirt with one and building the building with the other one. But if you have a mini storage over here and you have racehorses over here, I think you can do both of them. You just have to follow the rules. I think that's pretty important. We see people doing 506B and then converting to a 506C sometime in the middle of their offering, and you can do that. That's kind of new. And then the rule that, if there's a 30-day period from one offering to the next offering, you don't even have to really worry about the integration rules. So I think that's opened up quite a bit. The thing that I think we're going to see next year is work on finders. Right now there's only one no action letter that's out there that tells people how you can do a finders. And when President Trump was president the first time, he made a proposal on finders that didn't go anywhere. And I was at a conference in April, and they talked, the SEC and FINRA conference, and they talked about, well, we'll probably bring that back up. Well, they brought that back up, and now the discussion is, are we going to, in an effort to promote capital formation, which is always the issue, are we going to promote something that allows finders? And I think the negative on that is They don't want Seth and Gene to go out and start a company called Finders International and develop a database of 1,000 people and act like a broker dealer.
Yeah.
They don't want that. Some of the people I heard said, well, why shouldn't we track these finders? Are they putting people in deals that work? How much are they taking as far as a fee? And do the deals that they're in introducing people to actually work? And so I think there's a big problem, and I know that the broker-dealer community, which is something I've been involved in for years, the broker-dealer community doesn't want finders. So I think that's
self-preservation.
Yeah, that's going to be trouble, but I know that's going to be a hot topic.
Gene, I want to ask you something about that before you move on to the next thing. What are the proposed changes that would change what a finder's rule is now, which is very narrow, very hard to follow those rules, versus what they're proposing? Like what changes would happen if this were to pass?
I think you're going to have to register. There's going to be some database that the security industry is going to have that if you're going to be a finder, you're going to have to register so they can track you. I think there's going to be a limit on the fee that you can charge, and the question is, who's going to pay that fee? Probably the person that's the investor is going to pay it as opposed to the sponsor. And what education recommendation is the finder making on the product? Is the finder underwriting the property for the investor, or is the finder just saying, here, call Seth, Seth has an offering? And I think it's going to take a while to get that through, but they really have brought back the proposal from 2020, I think it was. I'm not positive that that's going to happen. However, you know, Seth, you and I have seen everything since the Jobs Act in 2012 being brought up with the purpose of enhancing capital formation. Every change we've made is toward that, except for maybe taking your primary residence out of your definition of accredited investor. That kind of cut back the number of accredited investors, but everything is toward capital formation. So they probably come out with something. And then the other two things I think we have to worry about is changing the definition of accredited investor. And I've heard this my whole career, but what I heard the last time at a meeting was really telling. When Reg D was, and I was in the business when Reg D was promoted in 81, 3% of the population, 3% of the households were accredited. Now it's 19% of the households, and the government really doesn't think that there are 19% of the households out there that can fend for themselves. How do we cut that down? How do we change on accredited investors? So I know that there's a congressional proposal that was passed that said, let's create a test. We'll give the investors a test, and if you pass the test, you're an accredited investor. So I'm not sure if I am a sponsor and you come to me and you pass your test and my minimum investment is $50,000 and that's all the money you have. Am I going to take you? Okay, you're an accredited investor. Am I going to take you? I think there's more to it. And you and I know about this. What test? What are they going to ask about to define your accredited investor in the securities world? Are they going to make you smart as a Series 7 person, or are they going to ask you about apartment buildings, or are they going to ask you about resources? What are they going to ask you? And according to the meeting I was at, no one wants to write that test, and FINRA, no one wants to administer the test. But there was a proposal in Congress that says we want to do that. That's called the Equal Opportunity for All Investors Act of 2025. Allow individuals to qualify through a certification examination that they're accredited. SEC has to create the test. SEC has to administer the test. It's been approved by the House, and it has to happen no later than 1 year from the passage in the Senate. Okay, so hopefully that'll never happen.
Yeah, it's just like us taking the bar exam, right? The bar exam tested us on securities laws and how to be a securities attorney, and we passed that with flying colors. So,
you know, I never had, when I went to law school, I never had a course that used the word security in
it. Me neither.
I never had that. Then the last thing I think we have to worry about is, or not worry about, Trump issued an executive order in August paving the way for 401ks to invest in alternative investments. So my law firm has a 401k. I'm the administrator of that 401k for my people. Am I going to allow my people to invest in your risky real estate development scheme?
Well, when you put it like that.
Yeah, you know, well, that's the deal. I have a fiduciary. Am I going to allow my employees to invest in Bitcoin? You know, I know what they invest in now, okay, and I'm pretty comfortable with that. But if we're going to allow the 401k, which is pretty important because there's a lot of money in 401ks, if we get that money out, here comes capital formation into businesses, you know, that'd probably be good for the economy, but I don't know if it's good for the administrator. What's my risk? You better write a good rule that I don't have any risk, or sure. I'm going to allow my people to do it. So we've got the integration rules that are opening up capital formation, changing the definition of accredited investor by administering a test, 401ks that might be able to invest in alternative investments, and the Finders Act. All those things kind of have a theme. They have the same theme, and so how far are we going to go? And I do know that the bottom line of the SEC people I've listened to is 19% of the families as accredited is way too much. How do we get that back down? What do we do? And one of the proposals that I heard that to me makes a lot of sense is, you know, when they took your personal residence out of the definition of accredited. I thought that was great. I live in Southern California. There's people that live on the ocean who bought a house for $35,000 and it's now worth $3 million, and they're living on their Social Security check, and they're accredited. Right. Please. So that was a good move. Now what they're saying is, let's take retirement funds out of the definition of net worth, and let's see that people have $1 million of net worth in assets, not in their IRA and their 401k. I think that makes some sense, and that would cut, according to the figures I heard, that would cut the number of households that are accredited down to 12%. Okay, you can still invest. You can invest with your money. We're not stopping anyone investing with their IRA, but we're not going to use that to qualify as, once again, people are sitting on a free and clear house. That doesn't count. They're drawing Social Security, and they got $1 million in their IRA. Can they invest in my racehorse program down in Del Mar?
Yeah. Yeah, there's a lot of changes on the table. I guess we will see which ones get passed all the way through, which ones actually take effect, and then we'll have to see kind of what that final regulation looks like. But, you know, generally speaking, like you mentioned earlier, it does tend to be pro capital formation, pro capitalist, pro more freedom to invest, I think. But we'll see. Like you said, if they put those restrictions on your retirement account, not counting towards the accredited investor, minimum, then that will certainly reduce the amount. But if they pair that with the ability to take some sort of a test or get kind of certified as an accredited investor, then
Sure.
you pair those two things together, then we'll see where it all kind of shakes out.
Yeah, I think that's all going to happen, and that just means we're constantly going to school, Seth. We're
Yep.
constantly learning. I'm taking courses online. I'm going to speeches. I'm going to conferences. I'm just trying to keep up with it. Keep up with it all the time.
Yeah. Yeah. Gene, I want to ask you this, kind of switching gears a little bit, but in a parallel universe, tell me about a different version of you. And let me frame that a little bit more. For me, I went to med school for about a year and a half.
Shit. Excuse me. You can cut that. I'm trying to turn off my phone.
I can put that in the
No, I'm going to call you back.
39.
Power off. Okay.
All right. Almost wrapped up, man. For me, it was, I went to medical school for a year and a half, and then I dropped out. But if I would have finished medical school, I would not have been an attorney or went down this entrepreneurial path. Would have been a totally different life for me. Give me kind of maybe one of those pivotal moments in your life.
Well, I've never had a W-2 job.
That's awesome.
Ever. I've always been 1099 or self-employed, and so I would stick with that. And what would I do? That expense, I've been in this business for 55 years. I don't think there's the one change I made was from dealing with investors all the time into dealing with clients. And so I think I would be involved in giving clients advice somewhere. Am I going to be a running coach? What am I going to do? I think I would be a mentor, giving clients advice. And I do that now. That's how I build my client base in my law firm. A lot of people who do come to me are doing their first deal, and that's pretty exciting if we get that done and we go somewhere else.
Fantastic, Gene. It's been great having you on the show, man. Where can our listeners find out more about you?
Website's the best place to go, www.tnllp.com for our law firm, TNLLP, and there you'll find you can get a free PDF of my book. You can order my book if you pay the postage. You can find out about our YouTube channel, and that's probably the best thing to do. If you want to call me directly, 949-855-8399. And as you can see, I can't figure out how to turn off my phone. So if you call me, I'll be able to. I'll take your call because my office phone is my cell phone. Okay.
Brave man, giving out the cell phone. I love it. All right, Gene. Really appreciate you having on the show. Thanks, man.
Thanks, Seth.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.